A normal cycle of correction for the Chinese economy, or is the government losing control? New government data shows the slowest economic growth in China for a quarter of a century. So, what's gone wrong, and should the rest of the world be worried? This is Inside Story. Hello and welcome to the show. I'm Sami Zaidan. Well, countries around the globe are nervously watching what's happening to the Chinese economy and fear the potential knock-on effects. New government statistics say China's GDP grew last year by almost 7%. Now, many countries around the world will be absolutely delighted with that. But in China's case, that is the lowest growth for 25 years. And another sign the heady days of record-breaking economic expansion might be gone. Well, the true situation could be even worse. Some analysts don't even believe the official data. As the world's second biggest economy stalls again, countries which export commodities such as oil and iron ore to China are suffering with the possibility of even worse to come. Florence Louis has more from Beijing.
For years, China has been the world's factory, relying on low manufacturing costs to make goods sold worldwide. More than 20 years of record-breaking growth has propelled China from communism to consumerism. Now the Chinese economy is stalling, and the slowdown is hurting many other economies worldwide. Commodity exporters who've relied on China as a buyer for years are now also struggling. Analysts say a slowdown is inevitable, given how much the Chinese economy has grown in recent years. They say high-speed growth is unsustainable and a reset is needed.
China is indeed in a moment of momentum transferring from old to new. Traditional industries are big in size, while these emerging industries smaller. So even though they are growing fast, emerging industries cannot make up for traditional industries' slowdown. So the overall economy is facing downward pressure.
Slower growth is expected to be the new normal for China. Already, analysts are predicting the economy to cool further this year, and even government measures such as increasing spending and cutting interest rates aren't expected to help much.
Chinese government leaders are encouraging everyone to spend more, hoping to shift the economy from export-dependent to a more sustainable, consumer-driven model. Some encouraging data emerged on Tuesday. Retail spending, even though lower than expected, still grew by double digits. And the automotive industry is forecast to grow.
Auto sales growth is lower than GDP growth, but the industry as a whole is doing all right because consumers are willing to upgrade their cars. Car prices are higher with better cars coming onto the market, so the whole market is developing pretty fast.
The government is already undertaking structural reforms, slowly changing from a centrally planned economy to a market-driven one. That will take time. For now, China and the countries that depend on Chinese demand for exports will have to put up with slower Chinese growth. Florence Louis, Aljazeera, Beijing.
Let's bring our guests into the show now then. In Hong Kong, we have Pauline Leung, Managing Director of Asia Analytica and analyst on China's political economy. In London, Chris Watling, Chief Market Strategist at Longview Economics, and joining us via Skype from Ningbo, China, Michele Geraci, Professor of Finance at Zhejiang University and an economic advisor to governments, corporations and investors in China. A warm welcome to you all. If I could start with Michele then, how are you reading this? Is the glass half empty or half full? Do you see this as a sign of trouble for China's economy, another cloud on the horizon?
The number was largely expected. As we heard before, this is part of this new normal, which the Chinese leadership has been telling us for the last couple of years already. They have already abandoned the famous 8% GDP target, and the narrative in the Chinese media, in the economic circles, has now shifted to lower growth rate. Even a few days ago, we heard the government officials saying that even 6.5 could be quite perhaps a challenge for the 2016, and even for the average, and even more challenging for the next 5 years until 2020. So the number in itself today did not surprise me. In fact, it was pretty much as we had expected. Still, behind this number, there are loads of interesting stories that one should analyze to understand the nature of this 6.9, where it comes from, and what it hides behind it.
Okay, and that's exactly what we want to do. But clearly the alarm bells are not ringing there for Michele by the sound of it. Chris, do you agree with that perhaps this isn't such a big deal as many people fear it is?
Well, I'm slightly more sceptical than that. I think we have an economy here that's had one of the biggest credit booms pretty much of any economy relative to GDP in the last 40 years. And what we know from the history of credit booms is they're generally followed by credit busts. Now, clearly, there's a belief in the markets and amongst economists and policymakers that the government is omnipotent and can manage this nicely and slowly and take the economy to its new sort of glide path level without any big bumps along the way. But if I look in various sectors of the Chinese economy, I see an awful lot of pain. Across analysis we did of 1,400 companies, profits are contracting by 40% year on year, revenues are down 10% year on year, and that's consistent with what producer price inflation is telling us. There's an awful lot of pain in a very significant part of this economy, and I find it hard to believe that the economy is just going to nicely transition through that to this wonderful consumption utopia that people keep talking about. No, I mean, China to me has got a lot of excess in it, and major slowdowns, recessions tend to follow economies that have big excess as they unwind those excesses. So, no, I'm not so confident that all is as well as it seems.
Pauline, Chris makes some good points there. I mean, when you look at the bigger picture, I mean, you can on the one hand say, of course, you know, the figures came in line with expectations. But when you look at other figures for the Chinese economy, exports weakening, domestic demand sluggish, debt is high, investment slowing. There is a bigger problem here, isn't there?
Basically, there are no growth engines. For exports, global demand is down. The cheap labor that had made China so successful, the labor pool is shrinking. Investment is on its last legs. It's been pulling the economy along for a while. It can't do it anymore. And then there's that much talked about switch to consumption. That takes time. People seem to forget that on a per capita basis, China is number 70, number 80 in terms of global ranking, about $8,000 per capita GDP compared with, say, the United States, 55,000, 60,000. So consumption is going to take time to be able to drive growth. So the outlook is really much, much slower growth for a couple of more years to come.
Okay, we'll get into what that means for the world. But before we do that, let me go back to Michele. Let me take a quote from Pauline there. There's no more growth engines left. What makes you, it sounded, shall we say, cautiously optimistic, confident that the government can manage this one? What advice do you give to government officials when they ask you for it?
Well, there is two things to look at it. You know, we tend to focus on GDP as if it was the only measure of economic growth. The reason why I am, on one hand, worried, and in a way I agree with Pauline, that the growth of GDP seems to be in trouble. On the other hand, let's not forget that there is a possibility that personal income grows faster than GDP. And at the end of the day, this is what matters to people. And we have signals that this is happening.
But is it happening fast enough, Michele?
I think so. GDP has grown by 6.9% real. Let's not forget that they've used a negative deflator. So the nominal growth of GDP has been 6.3 for 2015, while personal income has been in the range of 8.2 to 8.9% nominal. So let's say 2 percentage points. So personal income grows 2 percentage points faster than nominal GDP. And this is a little bit encouraging, because at the end of the day, people don't care about the GDP. They care about what goes into their own pockets.
Okay. Let me bring Pauline back into that. Are we forgetting, when people talk about the gloom and doom, are they forgetting to look at factors like the growth of personal income, which Michele was talking about?
Well, I want to take a step back and go totally low tech on this. If you look at the four big banks, their profit growth last year was around 1%. Nobody's going to get any pay rises, no bonuses, nothing. And that's the big state-owned banks. Companies are not making money. The outlook is quite grim in terms of debt. Instead of looking at all the fancy growth numbers, if you look at the fact that companies are not making money, banks are not making money, it's really hard to see where growth could be coming from in the coming years.
Talking about taking a step back, Chris, how do we know these numbers are accurate? There's been a lot of comment and doubt on them. Do you fear that maybe the slowdown could actually be greater than what we're being told officially?
Yeah, absolutely. I mean, I'd like to pick up on that and what Pauline said as well. I mean, the corporate sector sits at the heart of wealth creation in any economy, and if it's not functioning, if it's not profitable, it's not going to be driving investment and creating wealth. And that's why I go back to the analysis we did of 1,400 companies across China, where aggregate revenues are contracting at 10% year on year. So that makes me question and wonder about the GDP numbers, because clearly that's a wide section of society, wide section of companies, and they're not delivering any revenue growth, and their profit growth is contracting even faster.
Well, hang on, Chris. What about the numbers which Michele mentioned there, personal income growth?
Well, I don't see how you can deliver strong income growth if your profits are contracting 10, 15, 20% year on year. And I think that's the case at the moment, certainly in the companies we looked at. So, I have a lot of question marks. So it's very difficult to get good income growth data, very good to get wage inflation data, very difficult, to get good wage inflation data. So I don't have much confidence in that. But I do have confidence in the profit numbers that we see reported. I have confidence in the freight volumes we see in the railroads, the electricity consumption, all of these things which are deeply negative and raise a lot of question marks in my mind about the strength of the real growth that's going on in this economy at the moment.
Well, I can see Michele shaking your head, I think, in disagreement there, so I'm going to give you a chance to come back in on that. How do we know those numbers are right that you're talking about, Michele?
Well, and I reply to you and Chris, we have to address two separate things. Are the numbers right? And if they are right, do they look good or do they look bad? In a way, the fact that the company's profit shrinks is not entirely contradictory with the fact that the wages go up, because that's what people make. People make money from wages. So if wages go up, there is a pressure on profit. I agree. What Chris said is also there is a downward pressure on the revenue, which may be the more worrying thing. But just looking at company profits, it's completely in line with having decreased profit and increased wages. And that's what the rebalancing is about. It's about taking money out of the corporate sector and putting into the hands of the people, so that eventually, and I know it's going to be very difficult, consumption could be the main engine of economic growth. So my view is that even if GDP numbers are wrong, even if GDP growth is zero, personal income can grow above zero. And that's what makes people happy. Corporate profit would go down. It's a rebalancing. Plus, minus equals to zero, but it's a transfer of wealth back into the hands of the individuals. Because remember, over the last 20 years, personal income has grown slower than GDP. That's why there's been a great accumulation of wealth in the hands of the corporate sector due to what we always call financial repression, low interest rates, low renminbi, and low wages. Now, if this is to be reversed, China has the possibility, and I'm not saying that they will do that. I know it's very difficult and challenging, but it has the tools to make people better off, even in the face of a almost nil GDP growth.
All right, well, this is fascinating stuff, and we could go on, but perhaps we should talk about what this means for the rest of the world. Despite the slowdown in China, the latest outlook from the International Monetary Fund says global economic growth is still expected to rise this year. It's forecast to be 3.4%. That's a rise of 1/3 from last year. Advanced economies will drive global growth as they see what the IMF calls a continued modest and uneven recovery. The IMF, meanwhile, forecasts a generalized slowdown for China and other emerging market economies. With that in mind, Chris, do you think that the troubles, I know you're very skeptical, or slightly skeptical at least on this one, do you think it's going to drag down the world economy? Should the world be worried about some of the numbers that you've been mentioning?
Well, what we've seen in the last few years is all the pressure on global growth be pushed onto the United States. So we've been in this thing that people like to call currency wars, which is really just competitive devaluations that I think perhaps are even somewhat agreed upon amongst policymakers. But we've had Japan devalue its currency meaningfully in recent years. We've had Europe devalue its currency meaningfully in recent years. And now we're seeing a lot of emerging markets and devalue their currency, and even China to a certain extent. And what's happened is all the pressure of driving global growth is pushed onto the United States, the last sort of bastion of strength. And we're now seeing that economy start to slow. Its corporate sectors come under a lot of pressure. Its industrial sectors in recession. And let's not forget the kind of global recovery we've had for the last 5 years, based on really cheap money emanating out of the Federal Reserve, washing across the globe, artificially boosting emerging market economies and commodity prices, and driving global capex. 60% of the world's capex in the last decade is from energy and materials. That's all to do with cheap money and artificial growth. And yes, so I think actually the IMF will find they're too optimistic this year. I think the US is in danger of a small recession, and I'm sure the rest of the world will feel that if that so comes to pass. So, yeah, I think the effects from China are rippling out, as well as the effects from a Federal Reserve that is now tightening money in a world that needs ultra-loose money and a lot more QE than it's getting at the moment.
Interesting. Pauline, Chris mentioned currency policy there, the possibility of currency war, or we may even be seeing, some would say, aspects of that. What do you think this says about currency policy going forward for China and the decisions China will have to make?
There's a difference between the government's policy and what market forces are going to do to it. Because for the first time, the Chinese economy, the Chinese currency is not as firewalled from the rest of the world as it used to be. Now China has to open its current account, its exchange controls much more. So while the Chinese government, I believe, want to keep the renminbi stable, they don't mind a little bit of devaluation, but they certainly don't want to see any dramatic, plummeting of the currency. But there is so much in the way of money wanting to leave China for various reasons, from money seeking better opportunities, returns elsewhere, to money seeking political safety. So it's going to be a big struggle between the central bank trying to keep the currency stable and market forces inside China as well as outside pushing the currency down. So this is going to be a very interesting year.
A very big struggle, Michele, there is the way that Pauline sees it. Is there an easy way out? Some say China should have freed its exchange rate before this point, when money was still flowing in fast and furious. Now the economy is slowing, debt's piling up, the dollar is strong. Is there an easy way out?
That's a difficult thing, because I agree with Pauline. The financial and the flow of capital is a big problem in China. What I do recommend is instead of accelerating reforms of the financial system, they need to be much more cautious, more careful. So do not open the capital account, because then money would probably leave.
Market forces going to push against that, I think is Pauline's point.
True, but they are not technically allowed to take money out of the country in excess of, let's say, $50,000, although some regulations have been relaxed. There is a rule that, you cannot take money out of the country, to make it simple. It's not quite like that, but it is in a way. And, money leaves under, various forms, but the government could try to close the the stable before all horses are out. But that's a big challenge, and that goes down to, we have seen money coming out of other countries in other places around the world. And yes, there may be some capital outflow of China, but that will not necessarily imply that the country will go bankrupt. Capital outflow has happened in other countries. Some countries have managed it well, some less so, let's say Argentina and other South American countries. But I come from Italy. There was a capital outflow of Italy a few decades ago. The country has survived. The thing is, we worry about all these issues, and there may be problems, there may be crises, but the system, I think, could live on.
The system could live on. Chris, you didn't look very happy and convinced with that. Why?
Well, I wouldn't say the system won't live on, but I think there's a real challenge here and a bit of a paradox that you can't control everything, and China's trying to control its exchange rate, control its interest rates, and control the capital flow. And in economics terms, you have to choose two of the three. And at the moment, money is leaving Chinese economy very fast. And as I was explaining before, an awful lot of money flooded into that economy from 2009, sort of 2012-13. And it's now flooding out at a very fast speed.
Well, what's at stake for the world, Chris, if we try and broaden this out? Like, if your fears are validated, what are we looking at for the rest of the world?
Well, the important thing is if China has to take some economic pain, it either devalues its currency and the rest of the world takes some of it, and that eases China's pressure to a degree, or it maintains its currency and exchange rate at a very high level, an artificially high level, and it takes even more pain itself, in which case, commodity prices move even lower, and certain parts of the world take that pain. So, in a way, there's no winner here, but what happens on the currency dictates how the pain is shared out, if you like. So, and it's like, in some senses, it's in the Chinese authorities' hand, but it's not a system that's a good system. It encouraged way too much money to go into the country from 2009 to 2013. The central bank balance sheet in China is the biggest in the world by far. That's a telling stat, I think, that says it all.
All right, I want to give Michele a chance to come back on that. It's not a good system. You advise the system sometimes. What do you make of that?
Well, we advise, and I said, some things are done wrong, that there are some reforms that were mistaken. I take the example of the stock market reforms that was introduced at the beginning of the year that, in a way, amplified the market crash in the first few days. To give them credit, we did say, take it off, scrap this measure, and not because I said it, but they did observe the effect of their policies that was not very good, and they did take it back. They stopped it. So they have some kind of flexibility, which is, I have to say, a little bit unprecedented in China to admit policy errors. They've always been all along thinking they've been right. Now they trial, error, and when they err, they come back. And they did it so quickly, in 3 days, they took back that reform. So that's just an example of the kind of leverage that the government does have. It is not omnipotent, we know that.
Right.
But luckily they make decisions quickly.
All right, talking about quickly, we've got a minute left, so I want to give that to Pauline to have the final word there. A lot of what we're hinging towards now, Pauline, seems to be confidence in the system. How key is that?
Well, essentially, the problem is whether the authorities realize what they're facing. I have this impression that they don't need to choose between interest rate, exchange controls, exchange rates, that they can have it all. What happened in the summer with the stock market fiasco is this belief that they can control market forces by dictate. And until we have a feeling that the Chinese government, the Chinese leadership, realize that you can't fight market forces the way they've been trying to do, then I don't think that there's much confidence in the way they're going about it.
We're going to have to leave it there for now. Let's thank our guests. Thanks to Pauline Lung, Michele Geraci, and Chris Watling.